Hello and welcome to the latest Insider interview. Our guest today is Peter Spiller, manager of the Capital Gearing Investment Trust. Peter, thank you very much for coming in.
It's great to be here. I should mention I do not manage it on my own. So I have very able help from Chris Clothier, Alistair Lang, Emma Moriarty and Hassan Reza. So we're quite a large team.
Team approach, but you've been on the trust for more than 40 years now.
That's true.
It's quite some time. So how is investing today compared to those 40 years? What stands out for you in terms of opportunities and challenges?
Well, actually the circumstances have changed a lot over that period. So when I began in 1982, it was really a perfect menu for investors, because the 1970s had purged balance sheets. So balance sheets were really strong, and inflation was high but falling. Interest rates were high but falling, and because of those interest rates and because of the experience of the 70s, the PE on the S&P 500 was about 7. So quite a long way from where we are now. And our approach then was very much that when opportunities are good and risk is low, you should maximize the duration that you obtain. And the converse, when prospective returns are modest and risk is high, then you want short duration. So back in 82, we wanted very long duration. The longest duration asset is or are equities, and we had a lot of equities, and they were great years. But if we fast forward, perhaps I won't go through the whole history, but to the late 90s, we were seeing equity valuations very high and clearly very risky, and essentially a bubble going on in particularly, you will recall, in tech stocks. So we were very wary. But fortunately, there were other parts of the financial markets which were very attractive. So interest rates were very high. We could have basically 4% real on offer in a lot of markets. That looked extremely good. So we had, obviously, in line with that principle of having long duration where the risk is low and the return high, we had plenty of things like 30-year bunds. So happily we sailed through that recession. And I have to say that era is the one that is closest to where we are now. So we've got very high valuations. So on a Shiller basis, the PE in the US is about 30. We have an economy which we might come on to, but it's very fragile in our view. But there are plenty of opportunities as well.
And so how are you positioned today? What is that split between stocks and bonds, for example?
Well, it is as low in equities as it's ever been. So we have about 46% in index-linked bonds because the values there are fabulous in our view. We have about 12 or 13% in short-term credit, where we think the real yields are very attractive, and should produce something like, in nominal terms, should produce a little over 7%. Then we have another 12% or so that's in very short government paper, treasury bills, that kind of thing, and they yield typically 5.5%, that sort of thing. And then we have about 26% in what we call risk assets. So 26% in risk assets, of which slightly over half are actual equities. The rest are what are generally known as alternatives. So that would be renewable infrastructure, core infrastructure, both of which we might come back and discuss, but offer very good real returns. And within the 14% or so that is in normal equities, we have big overweights to Japan and to the UK, both of which look as though they offer very good prospective returns, and very little actually in the US.
So let's break into your positions then. So almost half in inflation-linked bonds. Why is that such an attractive place to be invested today?
Well, I think we just have to, Sam, just go back to the economy and its fragility. So what we are experiencing now is a result of nearly a quarter of a century of very accommodative monetary policy and what one might politely call experimental monetary policy in the last 10 years, so zero interest rates and QE. I'm always reminded of Bernanke's statement that the thing about QE is that it works in practice but not in theory. And I think the second half of that statement is the one that will endure. So the result of that monetary policy has been a massive misallocation of capital. And the reason why it could happen, just worth emphasizing, was that the admission of China into the global trading system produced such powerful deflationary force that it didn't really matter what you did, how loose you were. You could still get a result which didn't include a lot of inflation. So poor old Liz Truss, if she had been there and done what she did 4 years before, probably it would have been fine. But definitely wasn't by the time she did it. So the result of that is that debt has built up to alarming levels, the highest it's been outside of war. But so we've got just under 300% of debt to GDP ratio in the US, 333 in France. These are alarming numbers. But debt levels haven't really changed in the last several years. So the market's got very used to it and isn't alarmed by it. So one of the things we've had to look at is what is it that makes that fragile structure break? And the answer is either higher interest rates or recession, or obviously both. And so governments continue to indulge in very high fiscal deficits. And that reminds me of where we were in the 1960s, when inflation in the middle of the 1960s was quiescent. It fluctuated over the previous 5 years between 0 and 1.5%. But by the end of the 60s, it had built in the United States to about 6%. And that was because of persistent overstimulation by fiscal deficits applied to an economy that was already fully employed. And I think that's very much the situation that we are in today. And we have deficits in excess of 6% of GDP that I think both parties in America recognize are too high, but there is absolutely no consensus about how they should be brought down. Certainly no appetite for increased taxes, and certainly no appetite for cutting expenditure. So we just get these large deficits. That is causing a real problem with supply and demand for bonds, for treasury bonds, because the treasury bond market is currently about $33.7 trillion. and about 10 trillion of that needs to be refinanced in the coming year. You add to that the 2 trillion that the budget deficit requires, and a further $1 trillion for QT, and the market has to come up with $13 trillion, the market being either investors in the United States or from overseas, obviously. And we're about a year away from the Liz Truss debacle, when markets lost confidence in the budget system and felt the borrowing was getting out of control. And that saw a violent repricing and steepening of the yield curve. And there was corrected, of course, when she left office and Hunt came in and so forth. But there was just a hint of that a couple of weeks ago when the American Treasury market, 10-year Treasury market, went through 5%. And that was largely in response to fears of the kind that I've just laid out for supply and demand. Since then, we've had a quite powerful reaction by the Fed in a number of ways. So first of all, they orchestrated a large number of dovish speeches by members of the Federal Reserve Board. They've just yesterday, Jay Powell hinted very strongly that he's not going to raise rates anymore, and the Treasury has announced that they are selling less long bonds. So that's a classic way to, I have to say, to a concerning balance sheet for the Treasury, where the borrowing is all short. Just means you have to borrow more every year or refinance more every year. But anyway, and that's seen actually quite a big rally. So we've gone from 5 down to 4.7, so that's been great. But we don't think the problem has gone away. So we'll see. But we certainly believe that period, which I referred to earlier, where the forces of deflation were so powerful that you just didn't have to worry about inflation in the Western economies. And we're actually going back to what's normal. So what was normal was the post-war period. And in my very early experience in the 60s, that is to say, you have business cycles as opposed to the Great Moderation. You have inflation that goes up and down with those business cycles, and the average of those inflation numbers we suspect will be significantly higher than the 2% target. So with that as background, and so a very fragile market, I won't go into too much into the big threat to that structure, which is recession. So higher interest rates will be very damaging, and so would recession. In the circumstances, to be offered a guaranteed 2.5% real return is just wonderful, and that is what the TIPS market offers in the United States, because it's just so low risk, and it's a return which we think will be higher than that of the equity market going forward. In the UK, there's a similar situation. So yields aren't quite as high. They basically vary from 1.25% to 1.6% real. But with nice low coupons, individuals who own these instruments get an after-tax, even if they're higher rate taxpayers, an after-tax return that is only basically 20 basis points less than that. So once again, a very secure, reasonable rate of return without having to worry about anything. And in circumstances where the fragility of the economy might produce very strong negative returns in other assets.
Peter, it's been amazing having you in. That's all we've got time for, but thank you very much.
Sam, thank you.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.